Keeping cash is good for instant liquidity, but not the king in an inflationary environment. The best way to keep cash from losing its worth quickly during times of high inflation is not to let it sit around doing nothing. Instead, you can make money work for you through dividends. Put some of your idle cash to work by investing in dividend stocks with a rate of return that's higher than the inflation rate. In this video, we will show you 3 investment strategies, each better than the one before. We'll show how much you can earn from these investment opportunities in 1 year, 10 years, 20, and 30 years from now. In the end, we'll show you how you can combine these strategies with a portfolio, make it a safe investment, and still make upwards of $30,000 per month. John saved $15,000 from his everyday job. As he explored finance, he discovered dividends, igniting a desire for financial freedom. John wants his money to work for him before he retires. With research in hand, his $15,000 became a ticket to dividend stocks, and John found 3 investment strategies, each outperforming the one before it. First one on his list is covered call ETFs. Investing in covered call ETFs is one of the fastest paths to living off dividends. These unique funds offer investors the opportunity to earn income from both stock appreciation and dividend payments. So how does it work? A covered call ETF is a special kind of investment fund that buys certain stocks and also makes special deals called call options, which offers the right to buy a stock at a set price within a time frame on those stocks to make more money. They try to make these special deals as much as they can to make more profit for people who invest. When you put your money in a covered call ETF, you can make money like you're doing these special deals, but you don't have to do anything yourself. The fund does it for you. The beauty of these ETFs lies in their ability to provide income from both dividends and option premiums, resulting in a more stable and reliable stream of passive income. However, it's essential to understand that these ETFs come with some risks. For instance, options may expire worthless, or the stock prices may decline, impacting the overall performance. Some well-known covered call ETFs that John can add to his portfolio and invest in are QYLD, XYLD, and RYLD. These funds can give you good extra money, often more than regular dividend stocks. Let's see how much money they made in the past year. QYLD with a dividend yield of 12.1%, XYLD with 12.2%, and RYLD with 13.3%. If John only wants to invest in covered call ETFs, these 3 combined will provide an average dividend yield of 12.53%. Based on this, if John invests $15,000 today, by the end of the first year, the covered call ETFs can pay him up to $1,880. But the exciting part of this investment starts when John reinvests his dividends for the next 10, 20, or 30 years if he goes with this dividend snowball plan. In 10 years, his initial $15,000 will grow to $51,513, paying him an annual dividend of $6,764, or roughly $564 per month. In 20 years, the same investment will grow to $176,903, paying him an annual dividend of $23,229, or $1,936 per month. Taking it a step further, in 30 years, John's initial investment of $15,000 will grow to $607,515, paying him an annual dividend of $79,774, or about $6,648 per month. The reason for this compounding increase in dividends is that when you reinvest dividends by buying more shares, you'll receive a higher dividend payout next time. This allows you to buy even more shares, which further increases your future payouts. This process keeps repeating and growing over time like a snowball rolling down a hill, and it helps your investment grow faster and pay a higher dividend. Next up on John's list is REITs. A real estate investment trust, or REIT in short, is like a savings group for real estate. Think of it as you and your friends putting money together to buy a building, and the rent money is shared among you. REITs work in a similar way. People put money together, and that money is used to buy different buildings like offices, malls, or apartments. The money earned from these buildings is then shared among the people like John who invested. Historically, REITs have shown solid performance with an average annual return of 10% over the past 20 years. This means that investing in REITs can be a smart way for John to grow his wealth while earning a steady potential income. One great thing about REITs is that, unlike regular stocks, they often pay dividends every month. This makes them an even more attractive choice for people who want a steady income from the stock market. It's important to know that the amount of money you get from REITs can go up and down because it depends on how many people rent the properties and how the economy is doing. While REITs can give you more money than regular stocks, they can also be risky when the economy is not doing well. So how much does John need to invest to earn $15,000 a year from REITs? For this, we need to look at how some of these REITs have performed recently. Some of the best picks for investors are Blackstone Mortgage with a dividend yield of 10.8%, Orchid Island Capital with 16.6%, and lastly, Invesco Mortgage Capital with 18.8%. If John only wants to invest in REITs, these three combined will provide an average dividend yield of 15.4%. Based on this, if John invests $15,000 today, by the end of the first year, the REITs can pay him up to $2,310 annually. But what if John reinvests his dividends for the next 10, 20, or 30 years? If he goes with this dividend snowball plan, in 10 years, his initial $15,000 will grow to $67,975, paying him an annual dividend of $11,088, or roughly $924 per month. In 20 years, the same investment will grow to $308,043, paying him an annual dividend of $50,249 or $4,187 per month. Moving on to the big leagues. In 30 years, John's initial investment of $15,000 will grow to $1,395,955, paying him an annual dividend of $227,714, or about $18,976 per month. This shows with a slightly higher dividend yield, the compounding snowball effect is even more apparent. But as we said, REITs do come with inherent stability risk. They are known to be a little volatile. So if you want to know how to reduce that risk and still benefit from the higher yield, wait till the end, when we show you a portfolio of all investment opportunities together that is both safer and offers a higher yield. Next up, we have Dividend Aristocrats. Dividend Aristocrats are special companies in the S&P 500 group that regularly give money to their shareholders. Not just that, they also increase the amount they give each year. To become a Dividend Aristocrat, a company must keep raising its payments for 25 years. These companies are like champions of stability. They often sell things that people always need, even when the economy is not doing well. Investing in Dividend Aristocrats is one of the safest and smartest choices. These companies are good at handling money and making smart decisions. When they give more cash each year, it shows they're doing well. Even though they share money with their investors, they still manage to grow. This is a good sign that they're growing on their own, too. In simple words, Dividend Aristocrats are like super reliable companies that share their profits with shareholders and keep giving more every year. Investing in them can give you a reliable income and a chance to be a part of a strong company's success. And some of the best Dividend Aristocrats in the market are AbbVie with a 10-year dividend growth rate of 17.16%, Visa with 19.02%, and Broadcom with 37.71%. If John only wants to invest in Dividend Aristocrats, these three combined will provide an average dividend yield of 24.63%. So what kind of return can John expect if he reinvests his dividends for the next 10, 20, or 30 years? Well, let us show you. With the average Aristocrats dividend rate of 24.63%, in the first year, John's initial investment of $15,000 will earn him an annual dividend yield of $3,694. In 10 years, his initial $15,000 will grow to $135,618, paying him an annual dividend of $26,801, or roughly $2,233 per month. In 20 years, the same investment will grow to $1,226,149, paying him an annual dividend of $242,317, or $20,193 per month. Moving to the massive leagues. In 30 years, John's initial investment of $15,000 will grow to $11,085,853, paying him an annual dividend of $2,730,445, or about $227,537 per month. Like we said, the higher the dividend yield, the higher the apparent effect of the dividend snowball. Now, John may not want to expose all his investments to one specific strategy to avoid future uncertainties. So what's the best approach in this condition? For this, John can make a portfolio of all these strategies. Now, if you found the video helpful so far and are thinking of investing, you can join our free Discord community where the members help each other out. Click the link in the bio to join. Okay, back to our portfolio. We know the average return from our three strategies. The average return of covered call ETFs were 12.54%. REITs has an average dividend yield of 15.4%. And lastly, Dividend Aristocrats with 24.63%. If we invest in all these equally, our portfolio return will be 17.52%. Based on this yield, if John invests $15,000 today, by the end of the first year, he will earn yearly dividends of $2,628. But if he waits for 10, 20, or 30 years, his portfolio starts to reap the fruit of snowball compounding. In 10 years, his investment will grow to $83,326, paying him an annual dividend of $13,130 or $1,094 per month. In 20 years, the same investment will grow to $462,886, paying him an annual dividend of $72,940 or $6,078 per month. And in 30 years, it will balloon to $2,571,381 with an annual dividend of $405,187 or $33,818 per month. The best thing about creating the portfolio is that it still allows you to earn higher returns, but at the same time, keeps your fund safe. This video was about finding dividend stocks and turning your $15,000 into a fortune. But if you don't want to research, you can simply follow the advice of Kevin O'Leary, the Canadian millionaire, by watching our video on top 6 dividend stocks in Kevin O'Leary's portfolio, where we